back with Bryden Teich for a closer look at some of these market moves. What do you think of the increase in the grocery stocks yesterday? It makes sense?
Yeah, I think, well, they're very defensive businesses, and they've had a good few years with rising food inflation, and that's obviously really helped all of them. I think we had owned Loblaws a few years ago and sold it. Unfortunately, it would be nice to still own it here. I think the challenge for all of these very defensive names as a long-term investment is that they, like Loblaws, I think is trading near high 20s PE multiple right now, and I think the other grocers are as well. So you're paying a high premium for a business that itself doesn't really grow, and it's a good pass-through for food inflation. But there's not a lot of embedded growth in there for the grocers. And so on days like yesterday or periods where the markets get more challenging, I think these are really excellent businesses. But if you purchase them at the wrong time, like they might be, Loblaws 10 years from now might still be $200. But you've been in this period where it's really worked. It's gone from 60 to 200. Yeah. But there's not an embedded growth mechanism that I think is attractive to be buying them here. But they are good businesses in this kind of environment. That's
Dollarama released results yesterday. Needless to say, those results got lost in the news flow yesterday. There were other things on the minds of investors, but the stock did rally. Those investors who paid attention to the results bid the shares up, and there you see the market action. The shares rose by 61 cents yesterday to the highest closing price ever on Dollarama. What's your view of this stock?
It's a fantastic business. It's one that I wish that we had owned, and I think it's interesting how different the dollar store dynamic is in Canada, where you have a one-stop shop and dominant player like Dollarama, where if you look at a Dollar General or a Dollar Tree or Five Below or any of the other U.S. dollar store names, they've had a much more challenging environment because the retail environment in the U.S. is so much more competitive, where Dollarama, their offering and their pricing is so attractive, and I think their suite of products is excellent. I think they're definitely not immune to rising prices and, tariff costs and stuff, but I think the biggest difference with their business from just post-pandemic is they've demonstrated that they can raise prices more than I think the market was anticipating, where you used to go in and everything would be $1 or $2. Now if you go in, it's not a $1 store anymore. So things are $3, $4, $5, and that turn on pricing has just been an amazing thing for profitability. And the shares are expensive, but justifiably so. It's an excellent business, and if you can ever get it on a bad time, it's one to look at. But it's not one we own, but it would be very nice to own that. The Bay Street consensus on this one is 9 analysts say buy, 5 say hold, 1 says sell on Dollarama. Okay, we promised viewers that you would you would expand on your views on gold. Why do you hold significant portions of gold in your portfolio? Yeah, so we spoke about this previously the last couple of times I was on with you in the morning, but I think what's interesting in light of what's happened in the last couple of months is that, generally in these periods where the market has been weak, gold as a financial asset would suffer alongside of it, because it's a leveraged financial investment that people have, and so when the market has a liquidity moment, gold also gets hit. What was most interesting about yesterday was really, from our perspective, the move in the currencies. So you had these ridiculous high levels of tariffs announced, and the U.S. dollar was down. CAD was up, the yen was up 2%, and the euro was up more than 1%. And I think the clear end goal for what the administration is they recognize that they want a weaker U.S. dollar, and they need a weaker U.S. dollar. If you want to have any hope of revitalizing manufacturing, it's not, you don't need the dollar to go down 1%. You need the dollar to go down 20% and stay down for 10 years. And so that is a clear policy objective.
You think that's what they're driving at, a decline of that magnitude?
I think it's part of where they would see what the end game has to be. You can't, there's a reason why the U.S. dollar is as strong as it has been, is because everyone's financial surpluses get recycled back into the U.S. That's why everyone likes the U.S. assets and the dollar. The problem is that then hurts your manufacturing. So you have to have a weaker dollar, but they can't come out and say that. So gold is the one sort of international proxy for all currencies, and I think all currencies are going to have their ups and downs in this kind of tariff moment, but gold's strength is giving you a signal of there is a lot of demand for an alternative, essentially hard money currency. And I don't think that's going to change. I think there's such a persistent demand for it because of this new changing environment. At the same time, it's really run, it for sure could pull back, and you could have a sell-off in gold. That would be expected. It would almost be healthy. But I think that the game's changing in a way where, even gold at its price today, I'm not seeing the euphoria that existed in 2011 on gold, not even after the pandemic when it was at 2000. Like, there was a real clear sentiment shift back then. And today gold's over 3,000 and it's a yawn still in terms of what I'm seeing in terms of investor interest. It doesn't mean it can't pull back, like I said, but I think it's offering a real safe haven for this kind of market, and its strength in light of what's happened in the last several months, I think is a clue to investors that it's a place that you want to have some allocation to.
How do you achieve your gold exposure? What exactly do you hold?
So we hold 2 gold royalties. So Silver Wheaton or Wheaton Precious Metals and Osisko Gold Royalties are our largest positions. And then we have another producer in Australia. I think we spoke about this last time I was on. What's interesting is for many of the producers, you have not seen a response in their share price yet to a higher gold price. And I think the concern is still around the cost cycle and overall profitability, because again, mining it's actually a bad business. Mm-hmm. But when you get into an environment where your commodity is rising and your margin is then increasing, there's a part of the gold cycle where the miners will do really well. And the fact that they haven't responded yet, I think, tells us that we're still very early in this gold cycle. Price aside, I think that there's still room for the equities to do well. And I think people are very underinvested not for your hardcore always gold bug, but your general investor, I think, has very little, if any, gold right now, or any gold royalties or gold companies. And so for all of those reasons, I think it continues to be an attractive place.
It's Bryden Teich.